stop. Before you look at your positions this week, stay with me for 60 seconds. Because while the financial news cycle was locked onto missiles and oil prices, something happened in Washington that markets may still be underpricing. And it may be quietly shifting the direction of several major trades right now. Here's the setup. Alphabet, Amazon, Meta, Microsoft. 4 companies. Roughly $650 billion in AI infrastructure this year alone. The market started asking hard questions. Is this a bubble? When does any of this pay off? Stocks pulled back. Then right at the peak of that uncertainty, a planned presidential visit to China, the first of its kind since 2017, suddenly got delayed. And the way it got delayed may have changed the leverage dynamics in this trade more than Washington intended. On March 15th, Trump told the Financial Times the China summit could be pushed if Beijing didn't help with Hormuz. The next morning, Treasury Secretary Bessent said any delay would be driven by logistics and the Iran war backdrop, not by disputes with China or Hormuz pressure. By March 18th, the visit had been pushed back roughly 5 to 6 weeks. Mixed signals. 2 days. An already tense geopolitical backdrop. Here's what this video is going to walk you through. Why the summit delay may reflect a shift in negotiating leverage that markets haven't fully priced. Why China's actual energy exposure to Hormuz looks meaningfully smaller than public comments suggested. What this means for oil, the Korean won, and Asian equities right now. And the 2 signals that will tell you when this trade resolves. Let's go. To understand the summit delay, you need to understand what changed in the negotiating toolkit first. In February 2026, the U.S. Supreme Court curtailed Trump's ability to use IEEPA, the International Emergency Economic Powers Act, to impose sweeping, across-the-board tariffs. That was the tool that let the administration move fast and unilaterally on China trade. This didn't eliminate every tariff mechanism available. Section 301 investigations unfair trade practices are still in play. Section 232 national security tariffs remains available. But here's the practical difference. IEEPA let the administration act overnight. Section 301 takes months to produce results. You can pressure a counterpart with a hammer. You can't pressure them with a process. So when the fastest, most unilateral lever got weakened, the administration needed a different form of pressure at the table. That's the context for what happened next. The summit, the first planned U.S. presidential visit to China since 2017, had already been factored into market expectations as a sign of trade stabilization. When that expectation got put on hold, it became leverage in itself. The table became the chip. Here's what makes the summit delay worth studying as a piece of geopolitical communication. It wasn't aimed at one audience. Markets may be reading it as if it were 3 audiences, all receiving a different part of the message. Audience 1, Iran. The IDF said publicly last week thousands of targets remain. Operations are planned through June, with a potential extension of several weeks beyond that. When a U.S. president books a flight to Beijing, it reads as the conflict is wrapping up. The delay sends the opposite signal. Washington's attention is not moving on. Audience 2, China. The October 2025 Busan framework, a trade truce that markets had been pricing as a step toward normalization, was expected to be the foundation for this visit. By delaying and publicly tying it to Hormuz, the administration pointed at something specific. The strait my Navy is protecting moves your energy. That has a cost. Whether that pressure lands is a different question. That appears to have been the message. Audience 3, U.S. allies. Japan said no naval deployment. Australia said no warships. Germany's defense minister said, "This is not our war." Trump's FT quote was pointed. If allies don't cooperate on Hormuz, NATO's future looks very dark. The countries most dependent on Middle Eastern energy, Japan, South Korea, India, are also the least visible contributors to the security of that shipping lane. That is the tension the delay was designed to surface. 1 delay. 3 audiences, all receiving a different part of the message. Here's the part that may explain why this pressure campaign is having limited effect. Trump argued publicly on Air Force One that China imports 90% of its oil through the Strait of Hormuz. Many analysts measure China's actual vulnerability as considerably lower. Once you look at total energy consumption, not just seaborne crude imports, Reuters reported this month that domestically sourced coal and clean power account for around 83% of China's total energy supplies. China is no longer running primarily on imported oil. EV adoption crossed 50% of new car sales in China in 2025. Those vehicles don't burn crude. Renewable energy covered the majority of China's incremental power demand growth in 2024, and China has spent years building strategic petroleum reserves that provide several months of buffer against supply disruption. This wasn't accidental. China spent roughly 2 decades systematically reducing its exposure to exactly this kind of choke point, shifting from oil toward electricity, from imports toward domestic production, and building stockpile buffers. The strategic bet that looked expensive when China was making it looks quite well-timed now that Hormuz is in the headlines every morning. Trump's pressure appears to rely on an energy vulnerability that is smaller than his public comments suggested. And that gap between the pressure applied and the actual leverage it creates may be one reason Beijing appears in no particular hurry to respond. Here's the counterintuitive read on this situation. Every time a conflict like this pushes oil prices higher, governments around the world accelerate their shift away from fossil fuels. Higher oil makes solar cheaper by comparison. Higher energy costs make EVs more attractive. Every finance ministry watching crude near $110 has a stronger domestic case for fast-tracking clean energy build-out. And who builds most of that infrastructure? China manufactures the majority of the world's solar panels. China dominates the global battery supply chain. Chinese automakers have emerged as the global price leaders in EVs. Reuters and several analysts have noted that energy shocks of this kind tend to accelerate the global transition, and China is structurally positioned to supply much of what that transition requires. If oil stays elevated and the energy transition accelerates, China could emerge as one of the bigger industrial beneficiaries of a conflict that was supposed to pressure it. That is the structural dynamic, not a conspiracy, not a hidden plan, just the arithmetic of who sells what in a world that's decarbonizing faster under pressure. And it helps explain why, from Beijing's perspective, every additional week of strategic patience may improve the eventual negotiating outcome. Let's get specific. After the Bessent framework last October, foreign investors began rotating back into Korean equities. The thesis was straightforward. IEEPA. China trade normalization, global trade recovery, Korean exporters benefit. That thesis hasn't been invalidated, but it just had its timeline extended by at least a month and possibly more. In institutional positioning, a month of uncertainty often means reduce exposure now, re-enter when there's a confirmed date. Watch Kospi foreign net buying flows week over week. If they turn negative for consecutive weeks, the market is pricing in a longer delay than the official 5 to 6 week estimate. That's your early warning on this trade. Reuters reported that the Korean won breached 1,505 intraday in early March, the lowest level since 2009. That means 1,500 is not a future stress scenario. It's already a tested level. The mechanics are straightforward. Higher oil, Korea pays more dollars for energy imports, one weakens. Geopolitical uncertainty, foreign investors reduce Korean exposure, outflows accelerate. South Korea's finance minister and Japan's finance minister issued a joint statement on March 14th saying they stand ready to respond to excessive FX volatility. Joint ministerial FX statements don't happen in calm markets. The one is a real-time dashboard for how this situation is being priced by the market. Watch whether it holds below 1,500 or retests that level. Reuters reported Brent crude reached $109.95 intraday on March 18th. Here's the positioning nuance. A significant share of the Hormuz risk premium may already be reflected in current prices. What moves oil significantly from here may not be further escalation. It may be the resolution story. If Hormuz sees credible de-escalation and a summit date gets confirmed, crude could fall sharply and the knock-on effects would be meaningful. Inflation expectations come down, rate cut timelines reopen, risk appetite returns to Asian markets. That means the asymmetric trade right now may not be adding more oil exposure. It may be positioning for the relief trade and watching for the signal that it's arriving. Scenario A, early resolution. Most wanted. Currently underpriced. Hormuz sees credible de-escalation. Summit gets rescheduled officially from both sides for late April or May. Trade truce extended. Both governments frame it as a diplomatic win. Oil pulls back meaningfully from current levels. One recovers toward the 1,430–1,460 range. Foreign buying returns to Kospi. Korean exporters re-rate. Bank of Korea gets room to cut rates. Asia broadly rallies. The gap between what the market wants and what it's currently pricing is where the opportunity lives if you can manage the timing uncertainty. Scenario B, prolonged stalemate. Most likely based on current signals. Conflict continues into summer. Summit stays delayed. Treasury, China uncertainty becomes the market's new baseline assumption. Oil stays volatile between 100 and 120. One retest of 1,500 and potentially holds above it. Korean corporate earnings face a dual squeeze: energy costs up, export demand uncertain. Bank of Korea is effectively stuck. Can't cut with FX under pressure, can't hike with growth slowing. In this environment, domestic-oriented sectors, utilities, healthcare, consumer staples, tend to outperform relative to highly leveraged exporters. Scenario C, China acts as mediator. Lowest probability, highest potential market impact. China uses its Iran relationship to help facilitate Hormuz de-escalation. In exchange, concrete SU, trade concessions, tariff rollbacks, technology access. If this scenario is announced clearly and credibly, the geopolitical risk premium sitting on Asian equity markets could unwind fast. Why is it unlikely right now? Because China's negotiating leverage grows every week, this continues. The rational calculus is to wait for a better deal, not to trade away improving leverage for terms available today. Watch for any signal of semiconductor export restriction rollbacks from Washington. That would be the most credible tell that a bigger deal is being structured. Ignore the daily headline cycle. Here are the only two things worth tracking every week. Signal 1, Brent crude direction. Not the absolute level, the direction. If oil starts pulling back from current levels without a clear macro catalyst, it's worth asking whether something is moving behind the scenes on Hormuz. Smart money tends to reposition before official announcements. A sustained move lower in crude without a demand shock driving it is the earliest market signal for Scenario A. Signal 2, a joint summit confirmation. Not rumors, not diplomatic back-channel reporting, not one side saying it. A joint statement, White House and Chinese Foreign Ministry confirming a date. Both sides have to confirm. One side's announcement alone doesn't carry the same weight for markets. When that joint confirmation lands, the assets most sensitive to you, as sins. China trade normalization. Korean exporters, Asian equities, the one, tend to move quickly. The positioning advantage goes to investors already in place, before the announcement, not after. In October 2025, two leaders sat down in Busan. Markets read it as the beginning of stabilization. Foreign money moved back into Asian equities. The one recovered. Export stocks re-rated. 5 months later, the follow-up visit just got delayed by 5 to 6 weeks. And the same markets that priced in stabilization are now repricing uncertainty. This is the rhythm of geopolitical cycles. Not straight lines, sequences of expectation, delay, and eventual resolution. The investors who tend to do well in these windows aren't the ones who call the outcome. They're the ones who understand the structure well enough to be positioned when the signal changes. Two signals: crude direction, joint summit confirmation. When those move, everything else follows. If this breakdown was useful, hit like it genuinely helps the channel. Drop any companies or topics you want covered next in the comments. I read them all. Subscribe and hit the bell. The next video covers what happens to the AI infrastructure trade if this stalemate extends into Q3. You don't want to miss that one. See you there.